The silver bulls will be like, it's a silver squeeze, silver squeeze. We're not even in that yet. The volatility in silver will resolve with a much higher spike. And then when it's over, when the short has covered or the metal has come out, we'll probably see it back around in the 40s or 50s again. JP Morgan is the biggest silver player in the world. That's basically it. They have the Hunt Brothers silver going back decades now because someone's trying to take delivery in a disingenuous way, like on Black Friday. It's all related. On Black Friday, JP Morgan pulled metal off the market. Were they doing it because they didn't have it? No, they had it. JP Morgan has the metal. Were they doing it because they want to use it for something else? Possibly. Were they doing it because someone was a bad actor? Probably. And they probably went to Singapore and said, all right, which one of you guys is doing it? Now, when that happened, in China, you got a massive spike on the Shanghai exchange. A short on China got squeezed the moment that JP Morgan made metal unavailable in the US. So somebody's been pulling metal from the US.
What's your take on how silver was, let's say, sold off multiple times and how it would bounce back to the 64 level a few times and run through 65 and on into 66 and then hammer down once again? Well, what's your take on this?
I think that you have a world, this is going to tie into other topics you want to talk about as well. You have a world that's just changing in its demeanor, and that's the death of financialization, the re-rise of physicality. And I think for one reason or another, there is a physical shortage of available metal. Doesn't mean there's a physical shortage of metal, but there's a physical shortage of available metal. And these rallies and sell-offs are very symptomatic, as an experienced trader who's been on the wrong side of those. They're very symptomatic of a market that's being serially tightened. So less supply available, less supply available, less supply available. And then it gets ahead of itself, and you have these big dives. And the dives are paper dives. They're not physical dives. And I can certainly be conspiratorial about it, but I just want to put it this way. Futures contracts are sold at seemingly opportunistic moments. Again, not being paranoid about it. Like, for example, when the U.S. had the big sell-off, well, that's because Sunday night, China was going to raise their margins. So that was sniffed out, and longs probably leaked a little bit, and the longs in the U.S. got out first. And by the time it got to China, it was sell the rumor, buy the news.
Silver's volatility looks chaotic on the surface, but this part quietly exposes how paper markets can overwhelm physical reality. What's really being described here is a market where futures volume vastly exceeds available deliverable supply, a gap the LBMA and COMEX have long relied on. As analysts like Vince Lanci have noted, paper silver trades at over 200 times annual mine output, creating artificial price shocks detached from real metal flows. These opportunistic sell-offs don't reflect collapsing demand, but leverage positioning being flushed out. For investors, this matters because paper-driven drops can mask tightening physical conditions beneath the surface. And that disconnect tends to show up suddenly, not gradually.
So China rallied. I mean, it's kind of counterintuitive, but that's what happens when you have a market that's a real market, and silver is now a real market. Now, there's information leakage that makes it sell off. There's also data, or there's just a moment where somebody's just too long or too leveraged. But the buying comes in immediately thereafter. Silver does not usually have those V-shaped bottoms. Usually it's down and sideways. Silver gets those. We used to call them marble drops. You drop the marble off the table, it hits the table, it doesn't bounce, and then it just rolls off, But now we're getting, from L's to J's, from J's to V's, and we've had a lot of V's recently. So, for example, yesterday to today is one. And by the way, I know we're recording this Wednesday. So over the past 3 days, you've had a series of orderly rises in silver, behaviorally, with a spike followed by a steep sell-off and then an orderly rise. And what that is that's symptomatic from experience, from a physical player accumulating metal for real, not for speculation. That's this. And then it gets a little bit attractive to the momentum types, and it spikes, and then they realize they don't have enough money, and then it dives, and then the physical guy keeps coming in. So someone is catching the knife every time it falls. And that's what's going on in silver.
This part quietly signals a regime change in silver's market structure, not just a price pattern shift. Historically, silver's lack of V-shaped recoveries reflected surplus inventory and weak physical demand. But recent data from the Shanghai Futures Exchange shows record delivery volumes during sell-offs, suggesting real buyers stepping in. As Vince Lanci has pointed out, repeated V-shaped rebounds often indicate physical accumulation, absorbing speculative liquidations. Momentum traders create the spikes, but they don't sustain them. Balance sheets do. For investors, this implies volatility may increase while downside durability strengthens. The risk isn't owning silver here. It's misjudging why it refuses to stay down.
And that's the behavior in silver. And the reason for it is you have silver being pulled from London, which is still, for the most part, well, probably not lately, the acknowledged central place for physical silver, the LBMA, and you have been getting it pulled from India. You have been getting it pulled from the Middle East. You have been getting it pulled from China and the US. So London is basically, to use the analogy, a milkshake with 4 straws in it. And they have gone on the defensive. They don't have enough free float silver, which is what everyone talks about. They don't have enough extra silver anymore. And there's good reason for that. And that's because silver does have large industrial applications. And therefore, they can't go out and just borrow silver from someone to make delivery. And that's been a problem. And I think that's coming home to roost now. We're not even in, like, the silver bulls would be like, it's a silver squeeze, silver squeeze. We're not even in that yet. Like, a silver squeeze is what you alluded to on the before we went on the air, is what happened in nickel. That's a squeeze. We're not there yet. So I think the volatility in silver is warranted. The volatility in silver will resolve with a much higher spike. And then when it's over, when the short has covered or the metal has come out, we'll probably see it back around in the 40s or 50s again. I'm guessing. But pretty much, that's it. That's the silver volatility in a nutshell.
The 4 straws analogy matters more than most investors realize because it highlights a structural drain, not a speculative one. According to LBMA vol reports, silver inventories have declined steadily since 2021, while industrial demand hit record highs in 2023 driven by solar and electronics. Unlike gold, silver can't simply be leased endlessly without disrupting supply chains. That's why this isn't a classic squeeze yet. It's a slow compression. For long-term investors, this argues for patience and position sizing, not leverage. Next, Vince Lanci talks how volatility here is not noise. It's the price discovery process, straining against physical limits.
That explains it pretty well there. But with that, the nickel, what we saw with nickel, Chris Martinson from Peak Prosperity and you actually touched on how we saw the London Metals Exchange, or LME, shut down nickel when nickel was really going through the roof. And recently we saw COMEX shut down for a little while. And little known in that the LME experience and the COMEX experience is that these exchanges, they do have the right to change the rules as they see fit. And my question here, will these types of rule changing become, let's say, a more frequent event as we see more volatile silver supply, delivery, availability, prices?
That's a good observation and ties into some big picture things. Before I get to that, I want to tag one thing onto what we were just talking about. What I've been asking myself is, when did this all start in silver? And for me, as a silver person, it's been going on for 2 years now. But I think it started to catch fire on the day that you brought up, the Friday after Thanksgiving, Black Friday, traditionally it's called. And during that time, the COMEX and CME totally shut down. But during that shutdown, something happened that telegraphed to anybody who's a trader in the world, who looks at these sort of things, who understands metals, that there is a real physical problem. And that event was, during that time frame, JP Morgan has the silver in the West.
This part raises an uncomfortable truth markets prefer to ignore. Exchanges protect themselves before they protect price discovery. The LME nickel hold in 2022 wiped out billions in trades, and lawsuits followed because rules were changed mid-crisis. COMEX's temporary shutdown sent a similar signal: stability over transparency. As Vince Lanci has warned, when delivery stress appears, rulebooks suddenly become flexible. The Black Friday halt wasn't random, it was a warning flare. For investors, this means assuming continuous liquidity is risky. When volatility spikes, access, not price, becomes the real constraint.
That's basically it. They have the Hunt Brothers silver going back decades now. And they have silver that's made available for delivery. And that's, on the COMEX, they call that registered. So if it's registered, it's available. If it's eligible, it's there, but it's not available. And during the CME shutdown, they made approximately 13 million ounces unavailable during the shutdown. Now, when that happened, in China, you got a massive spike on the Shanghai exchange. A short on China got squeezed the moment that JP Morgan made metal unavailable in the US. So somebody's been pulling metal from the US. JP Morgan decided they didn't want to let their metal go, and that someone had to cover on Shanghai. And now this has been going on in to various degrees for probably months. But this became so obvious that I think the whole market is starting to freak out and panic a little bit. Since the day after Thanksgiving, Black Friday, I think the market has taken on a whole new vibe, for lack of a better word. So I wanted to tack that on. Now, the COMEX is an international global mechanism for silver. It's a globalist tool. And the world is no longer globalist. It's regional. And so I'm going to be a lot less likely to trade with you unless I know who you are. It's, the whole mistrusting is why people are buying metals to begin with.
The quiet detail here isn't the rumor. It's the 13 million ounces quietly pulled off the table. That move matters because registered silver is what backs delivery, and COMEX inventories have already fallen over 20% from 2021 highs, a fact analysts like Vince Lanci have repeatedly flagged. When metal becomes unavailable in New York and shorts get squeezed in Shanghai, it exposes how fragile this global pricing system really is. Investors should understand this isn't panic. It's counterparty risk being repriced in real time. And once trust disappears, liquidity follows it out the door.
Now, when you combine that with the fact that there's demand in China and there's supply in the West, and Asia's been pulling metal from the West for like 15 years, but now like the West is just figuring it out. Sad and pathetic, but that's the way it is. Bigger fish to fry, I guess. Semiconductors. So when an exchange feels violated, they change the rules. Now they're allowed to do it. It's on their books. COMEX it says it right in their bylaws. They are not a physical exchange. They have physical. You can get physical there, but the futures don't necessarily have to be delivered. Now they hold that right to do that because if someone were to try and manipulate the market by taking delivery in an unprofessional or uncommunicative way, because let's face it, when you're moving metal, you're not moving some abstraction. Like, hey, I want to take delivery of 100 contracts. I'll give you a heads up tomorrow. Something like that. You've already bought the contracts. They're already bought. You let people know because you actually want delivery. You don't want delivery, you tell them at the last minute. And the exchange has the right to say, wait a minute, we don't trust you. We think you're a rogue trader. And those rules are good rules, but they're also abused.
This part exposes a risk most retail investors never price in. Exchanges are not obligated to behave like physical marketplaces. As CME bylaws clearly state, future settlement can be altered under disorderly conditions, a clause rarely discussed on financial TV. Asia absorbing Western metal for over a decade aligns with World Silver Survey data showing net Eastern demand dominating since 2009. The danger isn't rule changes themselves, it's unpredictability. Next, Vince Lanci talks. If delivery becomes discretionary, futures stop being hedges and become promises. And portfolios built on promises break first.
An exchange can shut down because it doesn't like what's going on. An exchange can hold itself out to be, I'm the global liquidity pool for this asset, like the LME did. And then when the global liquidity pool wants some nickel, you're like, well, I don't have it. So it's kind of like a guy who's reliable until he's not, And I think the LME situation was an example of that. They canceled buy orders. There's lawsuits all over the place from that. It basically destroyed the LME. Now, if I'm the CME, if I'm a U.S. exchange, if I'm any exchange in the world, I look at what happened at the LME and I say, I can't let that happen to me, right? Which, by the way, is what's happening anyway. Because as you alluded to, and we'll talk about, I guess, next, is that the East is taking exchange franchise power from the West slowly. And that's part of it. So the rules are going to be changed the rules will be changed along with the supply chains. That's it. That's what's going to happen.
The nickel crisis wasn't a glitch. It was a stress test that failed publicly. When the LME cancelled trades in March 2022, over $12 billion in transactions vanished overnight, and trust vanished with it. That moment signaled to global investors that exchanges serve stability first, fairness second. As liquidity migrates east, this power shift isn't ideological, it's practical. Markets follow supply chains. Investors betting on Western exchanges as neutral referees may soon discover the rules change when pressure arrives.
JP Morgan, moving from New York to Singapore, their gold desk. Is this anything significant to you? Or how did you take that news?
Well, first of all, I haven't really had it verified yet. Can you verify that?
No, I can't.
You cannot, correct?
I cannot.
Okay. But first of all, I'm not going to throw water on this. Okay. I know it's a sensational rumor and it's a really good story, so people talk about it. There is smoke. There is some fire there. Now, did JP Morgan overnight tell everyone to move to Singapore? I mean, these stories. No. JP Morgan. No. JP Morgan is the biggest silver player in the world. They don't do anything overnight. Okay. So, for example, when I traded physical at night, before there was a liquid, like we had an electronic exchange, but no one used it. I would call Wolf. I would call Rouse. I would call Australia. I would call Singapore. I mean, my biggest trades were in Singapore at night. So every London player, every bank has presence in Singapore. It's not like they're not there. Now, I'm completely speculating as well, but here's what I would say is possible.
The real signal here isn't relocation. It's where price discovery is happening after dark. Singapore has quietly become a hub for physical metal flows, with Shanghai gold exchange volumes now rivaling London's on key delivery days. JP Morgan doesn't chase headlines, it chases liquidity. As Vince Lanci has noted, institutions position themselves where settlement risk is lowest, not where tradition lives. For investors, this suggests a slow but decisive gravity shift eastward, and when trading desks follow liquidity, markets eventually follow desks.
There is a problem getting metal back and forth between the countries. It used to be that you never had to move the metal, you would just financially arbitrage it. But now no one trusts anyone. So now if metal's going to go from here to there or there to here, well, I'm going to send, I already have representatives in Singapore. I'm JP Morgan. I already have representatives in Singapore. I have traders in there. But maybe I don't have my best team there. Maybe I have my junior traders there. Maybe I need to send a managing director over there to supervise them. Maybe I say, okay, maybe I send someone over there tomorrow. Meaning there's already a presence of JP Morgan in Singapore. It's like they got a vault there. So maybe I say I'm going to send my head honcho over there because someone's trying to take delivery in a disingenuous way, like on Black Friday. It's all related. On Black Friday, JP Morgan pulled metal off the market. Were they doing it because they didn't have it? No, they had it. JP Morgan has the metal. Were they doing it because they want to use it for something else? Possibly. Were they doing it because someone was a bad actor? Probably. And they probably went to Singapore and said, all right, which one of you guys is doing it? I'm making this up, right?
The most revealing shift here isn't logistics. It's the collapse of trust that once kept metals trading purely on paper. For decades, futures arbitrage replaced physical movement. But now delivery matters again, and that's a stress signal. As Vince Lanci has noted, when registered inventories fall and delivery requests rise, exchanges stop feeling abstract very quickly. JP Morgan pulling metal on Black Friday wasn't about shortage. It was about control. For investors, this highlights counterparty risk, returning to markets that were sold as frictionless. When trust breaks, power concentrates.
But look, I'm going to Singapore to tighten and deepen my relationships with the local trade because I'm doing more business here. And I want to make sure that everyone's on the same page. Look, if you lived, if you live in the US and all the volume is trading in Singapore, then you have to be up during Singapore hours. I'm getting more and more trade information from Asia than I am in the US now. Why? Because that's where the interest is. If that's where the interest is, you put your traders there. So overnight, left their laptops open and their coffee hot. That's ridiculous. They've been doing it. I mean, maybe I'm wrong. I could be wrong. I'm wrong a lot. But JP Morgan's got the biggest silver position in the world, and they're not small in gold. So if they're going over to Singapore, it's for a meeting. It's to meet a new customer. It's to straighten out their desk. Maybe someone tried to take delivery that should not have done it. Maybe someone was being disingenuous. Maybe someone couldn't make a margin call. I don't know. But, I would say that where there's smoke, there's fire. But it's not like somebody just dropped everything and they were, ascended into heaven. It didn't happen like that. But it happened. Something happened. Something happened.
This isn't about jet lag. It's about where price discovery is migrating. Shanghai and Singapore volumes increasingly dictate overnight moves, while Western desks react late, a pattern visible in recent silver futures volatility spikes. JP Morgan holding the largest silver position globally means their desk placement reflects flow, not rumor. As analysts like Vince Lanci emphasize, capital follows settlement reliability, not headlines. For investors, this suggests a structural shift. Asia isn't just consuming metal, it's setting the tone. And when information flows east first, risk gets repriced before New York wakes up.
Yeah, I agree. Something happened. I have my own little thoughts as to what happened as well. Unless there's a special deal or arrangement, but the government doesn't really work that way here.
There's been no information on metals for years. And now that there's information, you've got bullshit, which is filling the gaps between what's reality and what's not. And then you've got people like you, like friends of mine, like myself, hopefully, that have enough experience and are trying to suss it out.
We'll see how it unfolds.
The key signal here is the sudden return of information after years of silence. When data gaps persist, markets drift on assumptions. When information reappears, mispricing gets exposed fast. The US government hasn't meaningfully addressed physical metals, transparency since post-2011 reforms, leaving investors dependent on secondary sources. As Vince Lanci often warns, opacity favors insiders first. For long-term investors, this moment is less about predicting outcomes and more about recognizing regime change. When clarity returns, volatility follows, and preparation matters more than prediction.